All right, what's going on, everybody? TGIF. You having a good week? We've got high winds today. You wouldn't want to be doing any construction in my area. The other day, I was looking at things, and it at 10:30 in the morning, it said, "Hey, it's 82 degrees, but it feels like 96 with the humidity." It's like some things you don't need to share. You didn't have to tell me that. Yeah, yeah, that's a good tell right there. So I did a portfolio update. I tend to do it from time to time. It's not bragging, it's just pointing out that, even with just a little bit of time, these are accounts that I barely look at, and they just do their thing. The first one was from Public, which is what I'm showing on the screen now. The other one from Fidelity. As far as I know, neither one of those platforms have paper accounts, but you always have to be concerned with those gurus and gurus out there showing their paper returns and trying to just get clickbait, getting people to sign up for trash and follow them in social media. Be mindful of what's going on around you. The market, speaking of things going on around us, the market's not responding to much, really. I mean, we thought we'd have more of a reaction out of things, and we seem to be in like a hurry up and wait mode, oddly enough. So I don't know what's up with that. Maybe we'll kick off at some point and get to doing the thing. Maybe not. Right. Um, just a bit of a heads up. I'm not going to be getting into it today, but over the years, we've had people request, like an intro guide to trading, and I've always just left it to others to do. And we've got it on our website at the Bullish Bears. We got the introduction to trading, but it has holes in it, right? Like it's an impossible ask to cover everything on the intro to trading because there's just too many things to cover. So sure, the website has quite a bit. It's a good starting point, but there's holes. I'm trying to fill those holes. I'm putting it together. It's not going to happen in the next week, that's for sure. But I am putting together sort of an intro series to trading, trying to get people from, hey, I don't know anything, to being able to safely participate in the market. A lot of it is just getting people to be aware of the resources around them. If you're here and you're hearing me, you've already paid for something. You got the Bullish Bears. There's a lot of stuff out there you don't have to pay for. And just because you're not paying for it doesn't mean it's bad or it's trash or it's no good. I'm talking about really good things from the CBOE, uh, from just your brokers like Schwab or Robinhood, Webull. They've got publications and articles and background and uh, tons of videos on welcome to trading and getting started. And they are reputable sources, not, you know, Tommy sitting in his mommy's basement pumping videos out for clickbait. And, you can take them out, spin them around the block and see what you think of it. It doesn't hurt, doesn't cost you anything. So, yeah, we all have AI, but like someone was telling me the other day, if you know absolutely nothing about the subject, how do you know that AI is telling you the truth? Right? If you're new to trading and you're asking AI a bunch of questions, you can't necessarily trust the answers because you don't know if it's telling you the truth or not. That's a scary thought. So, yeah, just take it all with a grain of salt. Trust but verify, fact check, find answers from multiple sources, put in a little effort. So there is an intro coming. It's not ready, but I just wanted to shine a light on it and provide a little bit of hope, I suppose, that I'm going to do it because what it always comes down to is if you want it done, you just do it yourself. So, yay. I kept looking for the 10-year to turn around and head back in the other direction, and we got this itty bitty little bump. I don't think it's going to hold. But 4.32 is the line in the sand. Maybe 4.34 in today, right? I mean, that is more than enough for today. So, we're not even at 4.37. Let's get below that and worry about uh, 0.34. If that breaks, line in the sand is 3.2. But look, after falling from 4.3, we don't even want to talk about 3.3 or 3.2 by the end of today. That's going to start getting us into the realm of too much. If you're looking at the dollar, we have this sort of cowboy hat looking head and shoulders. It is worth paying attention to. I know the head and shoulders is the butt of all jokes, but a neckline break in the dollar, which was supposed to have gone back up into 99 and be threatening 100 at this point. If we break the neckline, the measured move gets us somewhere around like 98.3, and with an extension down to around 98, and that would be pretty wild for the dollar. So let's not do that today. Maybe next week sometime, spread out a little bit. We don't want one of these things, one of these big radical moves in 24 hours, from 99.2 to 97.2 is a bit much. For the ES, we got a little structure. We're just trying to go into the weekend quietly. We'll see if we can manage to do that or not. And I don't know, it still feels like the market is holding its breath, waiting on something. And I think the best we could hope for is maybe that we don't get anything and we just go quietly into the close. Yep. Yep. Well, Russia made comments about, hey, we've got nuclear physicists over there. And if you hit them and kill our physicists, we're going to be upset, which is where the 2 week deadline came in saying, all right, well, we'll give your guys people to get out. But that puts them on the clock and sets them up to be monitored. If you've got a bunch of nuclear physicists in a country and you turn on the lights and they start to scatter like cockroaches, now you can start to follow them, right? And they don't want them showing up on NSA and all the other ABC government databases around the world because they would suddenly be on the spotlight. People that maybe had been in the shadows, not being a part of any government's radar. So how do you move them out quietly? You got to give them a 2 week deadline and kind of smuggle them out of the country, and yeah, it's just a big mess. I know, right? Yeah. Yep. I you and me both. You know, when I read that, I thought, well, that's a bold statement to say that you've had your physicists over there helping them construct it, while they've been flat out saying we're not doing anything. Well, if you're not doing anything, what do you got all these physicists over there for? So it's a what do they say? It's an unfolding situation, or you know, it's still an actionable thing. Every minute seems like we're getting new heads up. And if we're getting it now, we are so late to the party that all the intelligence agencies have had it forever. That we're the last one to hear, just us Joe Schmoes in the public space. So they're going to do what they're going to do. And the best we can hope for is that we have something to wake up to tomorrow. So, you know, the markets are waiting, and that's all we can do is just wait. There's still plenty of things to play in the trade space, lots of themes that are working and some that are rotating, which, kind of maybe sets us up for the next leg, whatever that may be. We're coming into a new earnings season. It's going to kick off like the end of July, first part of August. And of course the banks kick it off first, and then we get the Mag 7 and the broader chunk of all the earnings. And they've been saying we're looking for the impact of tariffs. And most of the economic data we've seen does not support all the hyperbole we saw in the first part of the year. Like, oh, this is going to break the market. It's so bad for the economy. We're going into a recession. Just start cutting now because it's all going to crash and burn. We haven't seen that. Companies have taken advantage of things, sure, and they've applied additional costs on the products without really having any warranted reason to do so. Because why not tell a company that they've got a license to jack the costs up, and they'll do it and say, "Oh, it's not our fault; it's tariffs." So we've seen that, and there's an issue with labor, right? We've got headlines from California saying that you can't find day laborers; they just disappeared. Everybody's scared of the ICE raids, and they were quoting the billions of dollars being lost daily now because of this lack of workforce. But it's inappropriate labor anyways. I mean, just not even getting into the legality of hiring undocumented workers. It's the idea that they get taken advantage of. Hiring someone who can't complain about the wages and then paying them trash wages is just not right. Right? They deserve to be paid for the work they're doing. So I don't know, that gets down a whole other rabbit hole, but it's going to affect things. We're going to have costs rise. We're going to have shortages in various industries, the shelves at the store. So all of these threats that are on the horizons, other bricks in the wall of worry, waiting for the other shoe to drop, but there's still no dropping of the shoe, right? We just keep going on. That earnings that's coming up is going to be the one that everybody's been talking about. And if it doesn't highlight the broken market that all the economists said we would have, we could leg up, into 65, 67, 69 even. Some analysts have called for 7,100 by the end of the year. And, looking at things right now, it's hard to see that. But this is a market that's been like just holding back. And if they quit holding back and start piling into things, I think we're going to move really quick. All it's going to take is a wink and a nod that everything is okay. I mean, look how much we recovered already from 4,900 or 48 and a quarter back up to 6,000 so fast. We could go to 72 by the end of the year. With all the different products out there, I'd say tailor it to your account. Say a $1,000 account, you really can't buy SPY, right? But there's those S&P equivalent type ETNs or ETFs, double, triple leveraged products. You could grab something a lot cheaper to where your $1,000 will have more room to walk. And that avoids getting into stuff like options and just stays with the shares. That way you don't have to worry about decay because it's a long ways out. The idea that we would get vol crushed if we did run up that high, options are going to get volatility crushed like crazy. So just getting into some S&P equivalent would be the first recommendation, even if that means mutual funds, which is what I tend to do a lot of times in one of those accounts that I shared, the Fidelity account. That's almost exclusively just mutual funds, a few stocks to be sure, but mostly that's just mutual funds. You don't have to time it, you don't have to worry about decay or anything like that. You just get in it and let it ride. And they're not crazy expensive. A lot of the mutual funds that I trade, they're 20 or $30 a piece, which is way better than something like 570 or whatever in the S&P. So, or the Qs, just find a product. And if you don't like the indexes, you could focus on, say, the sectors themselves. XLF, for an example, is less than $50, or one of the other XLs. And certainly there's different ETFs out there. I like the spiders, the SPDRs, and the XL products, but there's so many different brands to choose from that you could pick one of those sector ETFs and run it that way. It doesn't have to be in the indexes themselves. And if you did want to do options, then I would scatter butterflies all through the higher realm up there and continue adding to it over the year as we get closer and closer to that target. Because you might not find, like 7,200 SPX at this point. You probably would, but it'd be like really illiquid, wide spreads and hard to fill. Probably have to leg into it. But if we're going to go up that much, and if we're talking about just a radical explosion in price that drives the market up that high by the end of the year, we would expect the risk on sectors to move at the very least. So XLF, XLK, and XLY. So you could choose those three. And then because of the backdrop of the data centers and uranium and all of that, the industrials should do good. Building materials. I don't know about energy per se, that generic XLE. I don't really like that product in this sort of discussion, but I do like the industrials XLI. It's already back up to those highs at 145. All it needs is just to GTFO, get out and go. And XLB might be a good recovery. It's still, working its way back up there, but that fits into the discussion, and the idea that, we'd be talking about a recovery that then goes into new highs, not just breaking out from new highs to continue higher. Everybody else is already talking about the downside, and I think that's where a lot of money is already positioned. And why not? There's so many bricks in the wall of worry. They've got all the people out there scared, and yet we just don't fall. So why not have, that right tail protection? I can't see a way around it. And I'm still long and out in my portfolios. I have reduced position size some, depending on what thematic we're talking about. But in the two that I shared in the chat, those are mostly broad market plays. So mutual funds and homemade ETF type things. So we had somebody show up in the chat the other day asking questions about putting together a watch list, and he tied it in with the options discussion, saying he went to the website and he was really having a hard time finding any content involved with learning about which stocks to look at to add to his watch list. Now, I took his post word for word. I didn't try to edit it to my own language because there's missing pieces and I don't want to make assumptions. But it was a part of, hey, I was looking at the bullish bears options material and I didn't find content involved with what stocks to look at and add to a watch list. So I'm going to put those two bits of pieces together and say he's looking for an options watch list. The other part of it would be effective research in how to conduct fundamental or technical analysis to start trading. That one's a good one. I'm going to leave for the later part of the stream. We want to first touch on this, the first bit, which is stocks to look at and add to a watch list. For the most part, when it comes to this sort of scenario, we have to think about your watch list versus my watch list, versus somebody else's watch list. You can't make the assumption that we're all using the same watch list for the same reason. And kind of point the fact, in my initial response to the person, my response was, well, what are you doing with that watch list? Is it, the list you're going to use to trade today? Is it your thematics list? You're putting together like drone stocks or, EV stocks. What is this watch list for? Now, don't get me wrong. I've got a list of stocks that I keep my eye on all the time in case they give me a trade, but that static watch list that does change based on market liquidity and other reasons, it doesn't change much, which is why it's the static list. Something that's more dynamic would be things that gapped up today or this month's most liquid options. That's a more revolving list where names come on and off and they just rotate in and out. So we need more clarity when we start trying to discuss putting together a watch list of stocks. So I thought, well, rather than typing all of this out, why not have the discussion in the live stream? Start with you personally. What is it that you're trying to do? Are you trying to make a trade list? Are you trying to have a list of stocks that you just always keep front and center? And no matter what your answer is, one of the best things that you can do when it comes to watch lists is elimination. I've always said, you may not know what you want, but you're probably really damn sure what you don't want. Right? I've never had to ask anybody if I like Coca Cola. I hate Coca Cola, but I don't need to ask. I know what I don't want. And even as a new trader, you're probably really clear about what you don't want. So start there. Eliminate things from the list that you are very clear on that you don't want. Maybe they're too expensive, or they're in other countries, or they're too cheap, or they have a low float, right? That they're just really thinly traded stock. Start by eliminating things, and that helps narrow the pool down, right? Because it's a big pool, 7,000 plus companies out there. I don't want to have to weed through all of those, right? So narrow it down. Start with that. For a lot of people just getting into trading, they're using smaller accounts. And so the first check mark is, can I afford to trade it? Now, sure, with options, we can pretty much afford to trade anything. But, you know, the best options trades have stock in there, right? They are stock trades that are just enhanced with options, not just pure options plays. Sure, you can do it, but from a new trader's perspective, why would you want to? So start with elimination. The next thing would be, as I mentioned in the answer, and if you guys are looking for where that conversation happened, it was in the questions tab. The next part was filter out those stocks that you do have. When we go to put an options trade on, if we're going to do credit spreads, for an example, we generally try to find things with a higher implied volatility. So we would look at the um, where's the vol. If we're going to buy debit spreads, we would want a low vol. Sell credit spreads, we want a high vol. If we're going to do calendars and diagonals, maybe we want, like a high front, low back. And if we're just doing butterflies, maybe it doesn't matter too much, right? Since it's just a neutral play. But putting together a watch list based on volatility is really helpful, and or a list that helps you avoid earnings. It seems like every week somebody reaches out and asks me about a stock just for me to say, yeah, watch out, that stock has earnings, next week, next month, whatever it happens to be. Today it was PLTR. I was talking to somebody, and of course, why not? This thing has been lit and it just keeps going and going and going. But it's got earnings at the end of July, right before August. So, you know, you always have to be mindful of earnings, and that should be on the radar. It wasn't PLTR, it was SoFi. That's what it was. Right before earnings, right before August, 7/28. And as a new trader, I remember taking trades, getting into it, and then realizing 30 minutes later, oh shoot, that has earnings next week, and it just got past me. So maybe putting together a watch list of stocks that had earnings so that you know that they're good and they're not going to have any anytime soon, or a list that is nearing its earnings announcement, because we do get stocks that make a move into its earnings, not necessarily up either, right? They might sell it into earnings, might buy it into earnings. Who knows? It doesn't always have a rhyme or reason. Nvidia is often one of those that makes a run into its earnings. Um, this was a nice, where was it? This was a nice fake out before it dumped back down into its earnings. But still, it was a nice ramp from like 112 back up to 142, $30 run. And then it just gave it all back right before it reported. Whatever. So the question about watch lists, even if you just don't even mention options at all, and you're just talking about putting together a watch list, you have to be more specific. What's the watch list for? When it comes to this conversation, I thought, well, let me just demonstrate a little bit of what that looks like, because I've got my own. So here, when I open up Thinkorswim, we have the ones that say personal. Those are mine. And then we have the ones called public, and that's what Thinkorswim made. And you can see I've got a lot of my own. It doesn't mean that I go and look at them every day. Some of these I put together because I wanted to have it if I wanted to go look, but I don't look at it all the time. Some are scans, some are just hand built lists. To line you up with the color code here, if you see the little green circle, it is only options. If you see the purple circle, it's stock and or options, but it was done with the stock part of the scan. And what I mean by that, if you're not familiar with Thinkorswim, is we've got the stock hacker, and in fact, you can kind of see the bubbles up there give away the color code. there's the purple, and then there's the green. So if your scanner only does options and was made in the options hacker, it'll have that green circle. And if your scanner was done using the stock hacker, it'll have the purple signal. You can do all of your options work in the stock hacker. You don't need the options hacker. Why they made two is basically somebody asked, hey, can you just make the options one? But the options one, everything that you can do here, you can do in the stock one. So you never actually need this one at all. You just stay on the stock one. So when I go in and look at my list, any that don't have that circle on it means it's one that I made for myself, that I put it together. Uh, Another little thing about Thinkorswim, if you have too many watch lists open, you'll start to get errors. So it doesn't hurt to have a blank watch list. It's literally just a watch list that doesn't have anything in it. I have 4 names in it. It's the 4 futures, but it's basically empty. I could open, 40 of those and it wouldn't break Thinkorswim. So, maybe have one of those on hand just so that you can eliminate a lot of your watch lists without turning it off. Because, if I delete this and then I want to go back to it, I have to rebuild all of the parts and pieces to that list, right? All these columns. And sometimes you don't want to do that because then you have to do all the work to put it back together. And it's easier just to put a blank one in there for the moment. So when we look at my list, I've got thematics and I have them dated so I can see that this was my 2025 list for Bitcoins, for China, drones, high options volume, but I had a more relevant date connected to it, home builders, quantum. It doesn't matter what the list is, right? These are just my thematic list. They meet a certain theme and I put it together in here. So from that list, I can go in and, strictly focus on that one concept. But then there's indicator scans, things like the a moving average bounce or a stochastics reaching a certain level, something like that. Just your basic indicator scans. And, to be fair, I've had those for years. I really don't use them, but I did the work to make them. I don't want to get rid of them. So there they are. But yeah, I kind of outgrew them over the years. So when you're putting together a watch list, don't think you're going to get it all done with just one list. All right. I guess this is where I'm going with this. If you're using something like TradingView, you can get a lot done with one list because it has sections in it, which are really nice. I wish Thinkorswim would get that feature built into it. It's the idea that in your watch list, you can have an empty column with a name in it, like, robots or EVs or whatever, that tells you everything underneath, this header is one particular thing. So here's TradingView, which again, I've got a lot of watch lists on TradingView, but this is my working watch list. And it's got chips, commodities, futures, countries, yields, treasuries, quantum, robotics. It's all in there, which is really nice. All things considered, it is really nice. But when I go, if I want something more specific, like just the robots or macro, right? Whatever, I've got those broken out individually too. So when you're putting together a watch list, be mindful you're very likely going to meet more than one list. I'm very likely going to take you up on that offer, Marziti, because I've got a lot of topics on the new trader front that they're not difficult concepts. They just need to be covered, and I really don't think that they've been covered adequately ever. And I want to. So hopefully this shines a little bit of a light on watch lists. Need more information to cover the topic better. Like, what are you trying to do? kind of thing. What I found over the years when people were asking about the stock part of an options trade, they had this mistaken idea that there was something within the candle patterns or the candle chart that would tell them, hey, you should go buy a call or put on a butterfly or trade an iron condor. It doesn't really work that way. Instead, run it the other way around, that you have a stock chart and you want to go long, you want to go short, you want to go sideways, because that's the three things that we can do with options. And from that, you decide what options trade you want to trade, right? That would be better served than thinking, hey, I'm going to go trade some butterflies today, and then trying to run a scan or a search or a watch list to find what would be a good butterfly trade. It's not to say that you can't do it, but you know, work from the top down, I guess, is a good approach. So we know that when it comes to options, those are our three choices: long, short, sideways. And we can even combine it a little bit, like short, sideways, long and sideways, long and short, but not sideways. As odd as that sounds, right? But that's what we can do. So you can take your personal watch list of whatever, whether it's thematics, country specific ETFs, things that have a high vol, things that just aren't too expensive, maybe things that are above a 200 period moving average, wherever your list came from. And then when you're going through the names on that list, you can look at the stock price on that thing, where it is, what pattern it's showing. Is it at the highs or the lows? And then have a more informed decision about, well, what kind of options trade do you want to put on that thing? Take two for an example. Hitting that 240 level, it has continuously tested this zone and fallen away, but we keep getting these higher lows. This thing really looks like it wants another leg up. So we could look at something like this and say, yeah, I think this might be a good long play and try for 245 or 250 by October or November. You're gonna have to give this one some time. If it breaks out and runs like it did the last time, we'll make that move, in like 2 weeks. But that's if we even get the move, right? So we take something like that, we go in and look at the options. Another part of that watch list conversation gets us into what kind of options traders are we going to be? Now, me, if you're new here and you haven't heard it yet, I'm a little bit of a snob. I am really picky about the options that I trade. I don't want sloppy seconds, right? I want something that I can bring home. So, if the options are poor, if they're trashy, ghetto, I don't want anything to do with them. I want a nice bid ask spread, a lot of liquidity, open interest. When I look at any name on the watch list, the first thing I'm going to go do is evaluate the kind of options that it has. And if they are poor, trashy, don't meet my criteria, I'm not going to trade the options in that thing. I don't care how good the trade looks. I'm going to use stock. I might do stock with like a single leg of an option, but that's a completely different kind of trade. It's enhancing a stock position with options rather than just trading options itself. So set some standards for yourself, I guess would be a good way to say it. If you don't know what you're willing to trade, then you are willing to trade anything, and that's really bad. What's your line in the sand? What is, bad options for you? I've got SoFi up, so I decided why not? We'll go ahead and use it. It's only the calls at the moment. I have the puts hidden, so I can see all of the columns that I wanted to look at. 2 penny wide bid ask spread in the money, 1 penny out of the money. It's a really nice bid ask spread, honestly, all things considered. Thousands of contracts traded today on at the money, on the money, in the money, around the money. If you look at the open interest, we've got a nice volume profile showing here. Now, that's not a must have thing, but I like to see it. It's good to see that. It shows, that we've got permanent people in here and they're not transitory, just running in and out. When I go farther out in time, here's August, there's that same profile, thousands of orders on there for today. Not every strike, right? But this looks better than Visa, MasterCard, Goldman Sachs, certainly better than Caterpillar, Dell, right? Those are all popular names. You would think they would have good options. They don't. This looks better than all of those. Maybe all those put together. Now, sure, if we get far enough out in time, we'll start to see it dry up a little bit. But here I am in September, don't really have that profile anymore on the open interest, but the volume is okay. The bid ask, it's starting to slip a little bit, 2 or 3 pennies now. This is tradable. You know how rare it is to be able to say that in today's market? This has tradable options. But if I randomly decide, oh, JP Morgan, everybody knows what JP Morgan is. Go look at those options. Yeah, not so much. $15 wide bid ask spread, $5 wide in the strikes, triple digits, so hundreds, not thousands being traded. What about July? Maybe July looks a little bit better. Not really. $5 wide bid ask spread, $5 wide on the strikes, hundreds being traded, not thousands. This does not look good. And this is JP Morgan. This is like one of the big dogs. Everybody likes JP Morgan. Their options are poor, though. It's ghetto, it's janky. So when you're going to put together a watch list, maybe one of your criteria should be what your line in the sand is for options. Are you the kind of person who's just going to trade whatever you find and you don't care? Or are you going to be a little bit of a snobby, picky person and you only want to trade the good stuff? I had somebody tell me once they only wanted to trade the ones that win. I thought that was interesting. Me too. I only want to trade those. But let me know when you find that list because that'll be the list I think that we all want to focus on. Just the winners. We don't want any of those losers. I'm sure it's a filter, right? Just filter the one that says just the winners. Yeah. So the other part of the request was effective research and how to conduct that research, how to conduct analysis. Um, I didn't hit it, but real quick before we go into that topic, the watch list topic. There are so many ways to trade, and a vague request for a watch list conversation doesn't even begin to touch this because it makes an assumption. I don't know what kind of trading you want to do. Discretionary trading, systematic trading, quantitative, qualitative, fundamental, technical. We got algorithmic trading, arbitrage trades, basis trades, carry trades, contrarian trades, dispersion trades. Yeah, I can keep scrolling, guys. I don't need to read them all off. I can keep scrolling and I'm still scrolling and I'm still scrolling, right? There's so many kinds of trades out there. When you ask someone about a watch list, if we don't know what you're trying to do, we have no way to really help you out. So be specific. Help us help you. And keep those in mind for yourself. If you're just wanting to really put something together on your own, what kind of trading are you trying to do? And if you don't know, well, then that's a really good place to start. Figure that out. Visa and MasterCard, by the way, are just getting their face kicked in. MasterCard worse than Visa. That's that's impressive. Almost like UNH. All right. So the other part of that question gets into how to do analysis. And I've shared some books over the years. It's always the same books over and over again. But a really good starting place would be to put together your tools, I guess. That's a good way to say it. So I've got a preset toolbox here. This isn't everything in my toolbox, but it's a go-to for me, especially when it comes to swing trading that I refer to all the time. Keeping your tools consistent helps you keep your analysis consistent. If you're all over the place in the tools you use and the analysis that you perform, your trades are going to be all over the place, right? If something that I do doesn't work and I get a losing trade, I want to be able to better understand why did I lose. And trust me, you're gonna lose, right? That's just the name of the game. It happens. But knowing why it happened gives me the confidence to come in and trade again, right? If I don't know why I lost, I get a little nervous because I don't want to take another trade. I don't know what happened. I don't understand. But if I take a trade and it loses and I understand exactly what happened, I'm more willing to trade again with an idea of let's not let that happen again, whatever it happened to be, right? So if your tools are the same and you apply them consistently, then when something doesn't work, you've got a much better idea of where things went wrong. Maybe there was nothing you could have done, right? Like you take a trade and the president tweets and smashes the market. Well, that wasn't on you. There's nothing wrong with your tools. There's nothing wrong with the analysis you performed. You just got a smackdown by a tweet. Nothing you can do about it. Move on and go to the next trade. But if your tools said to go long and you went long and then it crashes and burns, you can reevaluate what the heck happened? Why did it crash and burn? All my tools said to go long. Usually, when that happens, it's like a headline or something, news. But I've thought things were a double top or a double bottom, and it turned out later that they weren't, that I just read it wrong. So if we get the analysis wrong, we can clean it up. When it comes to the analysis, this is like an hourly chart. It's a bit more than that. It's like 65 minutes, but let's just call it an hour. It's nice and easy. It's a 1 hour chart. I have an hourly, daily, weekly. When I swap those out, and there's times that I do, I'll go from a daily, weekly, monthly. A little bit of a tip: if you're looking at a day chart and it's trash, go to a higher time frame. Right? So this is Visa. Visa looks fine. It's not trashed at all. But you know, this let's look at one of those like drone names or something. Here's EH. So EH, it's got a really nasty daily chart. It's all over the place. It's not as trash as I thought it would be, but whatever, it'll work. If I'm looking at the daily and it's just really nasty, hard to read, hard to analyze, I'll go to a weekly. But usually what I found is if the daily is hard to read, the weekly won't offer much help. And at that point, I'll go to the monthly. And I know I get it. You're thinking, well, I only wanted to trade for 4 days. I don't really think I need the monthly. Yeah, but sometimes the monthly gives you insight you just wouldn't have seen if you hadn't looked. So this trick works for anything. If you're using a 1.5 1.35 on an intraday and things get messy and you need help, take it from a 1.35 to a 5.15.30, right? Just go bigger. You'd be surprised how often that helps. So my default is hourly, daily, weekly. In the bottom, I've got the stochastics. I have been known to swap that out with like a MACD or something. I don't really lean into that too much, but it's there. I like having it on there. And on the weekly, I mean, it's basically worthless on the weekly, but still, whatever, it's there. Of course, we got the moving averages. You should always have moving averages on your swing charts. This isn't about trying to trade, moving average bounces or crossovers or things like that. It just is a really nice perspective of the health of the market that you're looking at. If we go to a weekly, for an example, and we use a very classic old school line in the sand, it's the 400 week. If you're looking at a market below the 400 week, that thing is broken. Institutions don't want to mess with it. It needs to recover. Uh, a lot of really good trades come from a 400 bounce. That stocks take a significant beat down, they get to the 400 week, and then they begin to rally back off of it again. And it's a nice long term trade, 3 to 6 months kind of stuff. Good trades. But if they break that 400 and they're underneath it, they are just long term broken. They can make continued shorts. You can still make money on those things, but how healthy is the particular market that you want to trade? I've had people ask, hey, you think UNH is going to recover as, like a long-term play? Could this come back? Sure, it can. You know what I mean? Like, yeah, look at Carvana. If that thing can come back, anything can come back. But is it a good, safe, long trade? No, it's underneath the 400 week. This thing is just broken. It's a company that nobody wants to mess with. So looking at the moving averages can give you insight on what's the health of this particular market that I want to trade. The shape of those moving averages, like the 200-day stocks, there's a lot of articles out there that talk about the 200-day bounce or the 200-day cross. And most of them, it seems, never talk about the angle of the moving average. So that if you're looking at a long term chart, say a 5 year daily chart, and there is a market that's been riding above its 200 period at daily moving average, like Apple here, and it comes down and it bounces on the 200, even if it closes underneath it, the the belief is it's going to go back up. Maybe just a short-term trade, but it's going to go back up because it's an upward sloping 200 period moving average. If it was a downward sloping 200 period moving average and we bounced off of it, we could bounce and rise up and hold above it, but it's more likely we're going to go back and revisit that 200 period again because it's downward sloping. Even crossing above the 200 for like longer term trades. If we come up to the 200 from below and we're trying to break above it and get through it and continue a long term trade to the upside, if that's a downward sloping 200 period moving average, it's very likely that the breakout above it fails. I don't know the percentages, but it's well above 75, 80% that it's going to fail, that it won't continue that breakover. Now I've got two purple lines here, and the purple is my 200 period, but the one that we want to focus on is the SMA, not the EMA. If I was on the weekly, I would look at the 200 EMA, but I'm on the daily and I want the 200 SMA. I brought up Carvana here, and we had this crossover in Carvana way back here. Everybody was so excited. I mean, this thing was like $2 at one point. So it broke above a downward sloping 200 period moving average, buzz beat underneath it, and then just ripped higher. I had a lot of people asking, am I too late? It outran me, blah, blah, blah. Hey, just relax. It's going to come back. Now, it didn't come all the way back. It didn't, but it gave back a lot of it because it got into what, nearly $60. And still, it came back to like 26, right? So why did it come back? Well, the 200 period needed time to flatten out, and then it needed time to begin moving to the upside. These are just big picture concepts, right? This is not about looking at a stock chart and say, well, I'm going to take a trade because it touched 200 or, something like that. We're just talking about performance analysis, which is what the question had focused on. So when I bring up a chart, I look at the tools that I look at every single time and I start asking questions. How healthy is this stock? Is it above that 400 week? Is it above or below the 200 day? Is the 200 day sloping downward or upward? Right? Those things, they may not seem like much, but to me, they really help me get a feel for the market that I happen to be looking at. Is it healthy? Is it strong? And even how fast is it moving? Because the 200 period moving average won't slope really sharply higher or lower unless we are outrunning it really fast. If you look at how Carvana ran away from the 200 to the downside, and look at how steep that thing started to finally point, it only got that steep because it was being outrun by such a great amount. Look at something more boring, say like Microsoft. And sure, we came out of the 2022 bear market. It wasn't Microsoft's fault, but most of the market came out at the back end of 2022, got into 2023. We outrun that moving average and it dragged that thing higher. And now we've just sort of flattened it out a bit, right? And if we zoom in through all the noise here, we can see it's starting to curl down a little bit. Why? Well, because we went flat, broke below it, went back and forth through it multiple times before we finally started to expand to the downside and we dragged it a little lower. But Microsoft didn't stay down. It ran back up and broke through it. And so now it's trying to curl back around again. But this whole thing, this flattening and now this little curve, this is just an indication of what the stock price did. So it gives us some clues. If you're wanting to trade good, strong, healthy stocks, make sure your scan or your watch list is focused on stocks that are above a 400 week, that they have an upward sloping 200 period moving average, because those are going to help you find healthy stocks. Doesn't mean they can't have bad news or bad earnings or, some other reason to break down and collapse, but they'll help you stay focused on good quality companies. Then you can tie in the liquidity from options and whatever else you want to look at. So that should be a really good start. When you put those two pieces together between the liquidity of the options that you want to trade and the health of the company or the type of quality that you want to trade, there's nothing wrong with bottom fishing. I like bottom fishing. And there's nothing wrong with grabbing things at all-time highs either. That one's a little harder to chew on, certainly, especially how did they get to the highs? A lot of those quantum as a service, those names and the drone names too, they became high flyers really fast. They just, screaming names to the upside. And they're going to come falling back down again because they got there too soon and it has a liquidity gap basically. There's no structure underneath them to hold them up. So they're going to fall back down. But even in the fall back down, they're developing the structure that they need and we are getting, the higher lows that we're looking for. I brought up Ion Q. We've got the 200 period and the 400 period moving average. 400 is a bit much, but I mean, it's there. It's the 400-day. It held above and it's working it out. Problem is we haven't made new highs, right? We broke above 50. We took a rejection from that, fell back down. We've got to get through that 50 level. It's a big line in the sand. If 50, then 80. I know it seems kind of vague, but if 50, then 80, if 80, then 100. And that's, there's some market truism there. We've got an upward sloping 200 period moving average. When we danced with it, we immediately came right back above it. We didn't linger down there dragging our feet. And at the moment, it seems to have a pretty strong relationship with that 10 period moving average. It doesn't like to get too far away from that thing. When we get too far away from the 10, it seems to mean revert really fast. Now that's the 10-day. And when we're talking about mean reversion, you're better off with the 10-week. But, we can start with one and work into the other. The 10-week is another one of those moving averages that will really help you with your technical analysis. How far a market is from its 10-week. Now, it's weird. I don't know if you guys have ever heard this before, but markets have relationships with different moving averages. Most of them are common, 10, 20, 50. 200. But every once in a while, you'll find an odd relationship like 34 or 32, um, a 74, 62. Just, and if you're asking me, like, how would you even know? Like, what do? Do you shop around through every moving average number? I have, as odd as that sounds. If you bring up your normal moving averages and nothing lines up, well, I'm a bit of a nerd and I don't like not knowing. So I have shopped around until I found the one that matches the particular chart that I'm looking at. But usually they'll run with the group. So how far away we are from the 10 period moving average on the weekly, that's the mean. It's the average price, I guess is a good way to say it. It's not a fair way to say it. I think somebody could probably clean that up a little bit, but if that's quote fair price, when we're above the mean and they're still buying it, it shows how much they really want it. Because they know what the average price is, or the real price, fair price. And if they're buying it anyways at those valuations and they still want it, then maybe there's something to be said about it, right? But anything that gets too far away from the mean will eventually wobble and fall. Think of it like somebody climbing the water tower. As long as they don't look down, everything's fine. Get too high up in the air and then you look down, you get vertigo, you slip and fall and down you go. So with those high flyers, sooner or later the market gets vertigo. And where does it go? Back to the mean. Usually overshoots the mean. The mean on my weekly is this light blue chart line right here. Might be hard to see in the live stream, but it's about $36. So if we overshoot that, get too far away, we'll crash and burn. In the morning streams, I made an indicator that measures how far away we are from the 10 week. And I apply it to the same market every day, the ES. I know the ES's levels and how far is too far because I look at it every day. But if you're trading some company and you've never looked at its relationship with the 10 week, you have to start from scratch. Does it like its 10 week? Does it use it? Does it respect it? Does it have an issue with getting too far away from it? Once you evaluate that particular market with its moving averages, you'll have a better idea of how to use them going forward. And again, this isn't about the market crossed the moving average, so I'm going to buy it. That that's not what we're talking about, right? It's just analysis. Using indicators to evaluate a market's health or performance. Is the momentum there and increasing? Does it have trend? Is it losing its trend? So that we can make a more informed decision about how we want to trade it. So to perform analysis, start with the idea that we need certain things. Stockcharts.com has a list that talks about momentum, trend, volume, and I would say volatility, but they don't have volatility, but I would say volatility. That you want a piece of those four quadrants on your chart. And there's a lot of ways to get those quadrants covered. If we look at Thinkorswim, for an example, I just go to studies and we load study set. No, just studies. Here we go. We can do momentum studies, trend studies, volatility, or volume. Maybe have something from each category so that you can check the box and say, well, how's the momentum? How's the volume? What does the trend look like? It doesn't mean that you're going to find something when you look, but at least you looked, right? Sometimes I look at volume and there's just nothing there to see. It's not wow volume, it's not bad. It's just yeah, it has volume, but nothing really stands out. You don't know till you try. But put together your analysis tools and try them for a good 6 to 8 weeks. If you don't like the ones you picked after 6 or 8 weeks, try a different one. And what I mean by that is if we go to momentum, we've got the CCI, the MACD. We probably have the stochastics in there. We've got, yeah, there's the stochastics. So TTM squeeze, all of those are momentum studies. Maybe you want to use the RSI and you try it for 2 months and you decide, you know what, I'm not really impressed with the RSI after all. Maybe I'll go with the rate of change. Sure, try that. But don't swap around every other day from stochastics to RSI to MACD to rate of change. You're not going to get anywhere. Pick one, use it for a while, give it a true, honest evaluation. And if at the end of it you don't like it, move on to something else. The really cool thing about all of these old school indicators is they've been around for, a good 25 plus years easy, and that there are YouTube videos, books, webinars, theories, classes. There's even been college researched white papers on every one of these major indicators. So when it comes to learning about what an RSI does or a MACD or stochastics and the multitude of ways that you can use it for analysis, there's a lot of background and research there. You don't have to do the work yourself. It's already been done. All you got to do is go read it or watch it on a video. Take notes, study it. If it's one of these newer indicators, then sure, you're going to have a harder time with it, right? Like the polychrome, I don't even know what that is, right? So if we were going to use this, I would first have to figure out what the heck it even is, right? It's a new thing, I can tell you that, but I don't know. Hey, you have a good weekend, buddy. Hope you get done with that without getting a heat stroke. Ah, that sucks. I feel you guys. So analysis, there's no wrong way to go, and no matter how good you do it, it won't account for headline news or a tweet, right? That sort of stuff, which is really frustrating, will break a market that you've done all the work in and all the research on, and then it just gets whacked and it sucks. But that's the kind of backdrop that we're in. Another thing that is probably a little hard to see on my screen because I keep it shaded is these Bollinger Bands. They are there, but I keep them really light because, well, I don't want them to be intrusive. So I made them nearly transparent. And when I'm looking at those, I want to see, are we hitting it like we did back here when we hit the edge and rejected, or back here when we hit the edge and rejected? But I also want to see what's the shape of it? What's it doing? Is it curling in like it did there into a squeeze before we broke out of the squeeze? Or here? Is it expanding outward or is it curling in? The shape of that thing really gives me some insight. Bollinger Bands, if you didn't know, are a volatility tool. Yeah, there are other things too, but they are a really good indication of volatility. And for people who don't trade options, when you mention volatility, they usually freak out, try to pull their eyes out, and they just run away screaming, tune you out. They won't listen to you because you started talking about volatility. If you talk to them about the Bollinger Band, they'll listen because they don't know it's later. So with this thing, we can look and see, is volatility increasing? Is volatility decreasing? Have we been in a high volatility environment and it's now, going back down again? Did we just get here? All of that can be seen from the Bollinger. I heard somebody talk about the Bollinger once. They used this phrase and it stuck with me ever since. When we're in a narrow Bollinger environment and a stock breaks out and it hits the edge of the Bollinger Band won't immediately expand. That the stock has to keep pressing against that Bollinger Band and forcing it, stretching it wider, like stretching leather, right? Or stretching leather is the best I got. Um, Hold on, guys. All right, sorry about that. Let's see what's going on in the market. We're in the last hour, getting into power hour. Maybe we'll get a little surprise here. I'm not expecting it, but it is trending lower. Let's just put that R line on from 9:30 to where we are now. Yeah, that kind of speaks for itself, doesn't it? Redraw that as a channel. Hey, look at that. We got as low as 59.52 in the SPX today, but we just couldn't get below 59.50. And at this late in the game, I think if we do, we could get to 59 really fast. What would that cost for a 59 strike put just for the end of the day? Probably something really cheap. Five pennies. I should have known. Yeah. I mean, it's a snowball's chance in hell that we would actually get there. But if we did, that $5 would be worth $500. It's not a bad risk to reward there, all things considered. But there's no reason for us to do that, right? Like, I mean, we really shouldn't do it. And if you wanted to do like a Jeremy style approach to that, you could, try to sell a deep in the money call credit spread for like $495 in credit. It has to go by fives, right? It doesn't have penny increment options, so you can't do like 4.99 or something. It's going to be a nickel at least. But if you could sell that for 4.95, and then we actually do start to break down and fall out, you could buy it back cheaper than 4.95, and there's your profit. Worst case scenario is that it closes in the money and you're out that 5 pennies plus the commissions and uh, the assignment fee, all that stuff. So maybe use the XSP. The assignment fee maybe isn't going to be so much, but it's cash secured. You don't get shares of that thing, right? Because there are no shares. So you don't have to worry about, like assignment. It's nice. First time I ever heard Jeremy talk about trading a in the money call credit spread on a 0 day. I'm like, what are you crazy? Why would you do that? But I mean, if you think it through, it's really not as risky as it sounds. if you're on the XSP, you do have penny increment options. So you could trade something, say, just walking closer to that blue line, the 593, 594. Oops, flip that over. Trade that for like 98 cents, 99 cents. Then you're going to be out, a penny if you're wrong, 2 pennies. Yeah, yeah. I don't think we're going to do it, right? But look at how we're just holding the line there and we're hovering in this little bitty box and we're underneath that half. And man, if we were going to do it, it would happen from like right there. I feel it. We probably won't. We don't have any reason to. One headline is all it would take and just bam, do the thing. That is a 5 point range. And technically, it's possible for us to just go into the close within this 5 points. What's more likely is we get a little bit of a shot to the downside, and then we run up and like get VWAP or something, right? That we actually don't crash into 59.50, which would be new low on the day, because we don't have any reason to do that. Makes you wonder if anybody's trying to 0 day that thing, huh? So one thing that you can do near the end of the day when it comes to watch lists, this is a nice little thing. I do it on Thinkorswim, but I think other brokers can do it too. Is you want to find high option volume products, not necessarily for today, right? For a watch list. If you run this first thing in the morning, you won't get anything because the market hasn't done anything yet. So you want to run it near the end of the day. And you're basically asking, who had high options volume today? Now, granted, you can get an outlier, say some Joe Schmo biopharma company had a drug trial come in and one day they had volume. Great. That'll show up in your scan. But it'll also show you a lot of other names that may be something that wasn't even on your radar that's been getting options flow for a while. So I'm going to hit the plus sign. I hit refresh, clean this out. It was brand new and I eliminated everything that showed up. Now I'm going to add an option filter and we're going to use volume. Why not? Right. And we want the minimum side and we don't know where to start. So we just throw a number at it, say um, 100,000. Show me things with 100,000 options volume. And if that's too big, we won't get anything. We got 4 names and they're pretty obvious names, right? AMD, NVIDIA, Apple, Tesla. Duh. Thanks, Captain Obvious. So what that told us is the number's too high. We'll back it off. Try 90,000. Wow. We're really not getting much today. We're going to really back it off and knock it down to 50,000. Really? We got another name, Amazon. This is just a really not very liquid trading day today. Let's try 25,000. Where is everybody? All right, we got 19 names, and GNL stands out as an odd one. It's a REIT. Then we got some Bitcoin stuff, some brokers like Robinhood. UPS is on there. That's odd. You got my attention, sir. All right, Coin's just running that continuation out of the TTM squeeze on the daily. Circle Internet Group. I I've seen this one showing up in the gap list in the mornings that I post, but I don't know anything about it. Yeah, what a really great example of poo. That's trash. DoorDash, Amazon, Apple, CoreWeave is another one that's been popping up quite a bit lately. Really nice move since May. I mean, it's just been wow. Double Google, Nvidia, Palantir. I'm a little bit surprised with UPS. This thing has been just a dog turd out there in the lawn. You can see the trend, hopefully, right? Big broken gaps down on earnings, just a punishing, brutal drop to the downside. And it's not done. By no means is this any sort of a bottom fishing play or recovery trade. Nothing like that, right? It's just straight up broken as a company. And after such a magnificent beatdown, probably not something that you want to even try to go short in at this point because it's already had such a beatdown. If you did want to go short off the highs. So that 103, 103 and a half sort of play. But yeah, that's I'm curious though. I can't help myself, like watching a car wreck. What happened to the options? Oh yeah, 6 times 4. So we've got 4-to-1 calls. A lot to call sizzle. It's running at 480% above average daily options volume. Way out of the money stuff. Most of the calls are hitting between 0 and 40, but nearly 50% are between 20 and 40. So they're way out of the money calls. It's the 90 strike. No, excuse me. That's the put side. On the call side, way out of the money. 105, 110s. I guess even the 115s. That's your open interest for today. 110s. So there it is. Didn't really see him, huh? 38,000 with 16 and 18,000. Really far out of the money. There's nothing on that chart that makes me like UPS. Not even a little bit. A really beautiful trend, though, right? If you wanted a textbook example of trend, ta-da! So when it comes to performing technical analysis, the idea is work on a consistent backdrop. And there's no wrong way to go, but try to cover those four groups. I've done work on this before, but I'm gonna give you guys a little cheat sheet to this. If you go to stockcharts.com and you don't need an account, right? I'm not gonna log in mainly because well, I don't have an account there anymore. I keep threatening I'm gonna go back and get one, but I love this site. Of course, it would help if I can spell. We're looking for multicollinearity. They wrote a really nice article on this, and it has those topics. There we go. Momentum, trend, volume, and then I would add the last one, volatility. If you read this article, they give some ideas of putting at least one indicator from each group on your chart and then using that for a consistent analysis approach. It's a really good article, and they have a list of indicators here on the far right side. In the middle is the one that they chose, but you don't have to choose the one that they chose. So pick one from each group, apply it to the chart, make sure you know how to use it, not just the off the cuff, oh, I know what a moving average is. I'm so sick of hearing that. But actually a deep insight on what the indicator is and what it's designed to do, and then use that in your analysis. I know we're not all digging into things the same way, but for an example, I spent months learning about moving averages. And I'm not an idiot, right? So I could read one article in one day just like anybody else, good, 20 minutes I'm done. I didn't spend months of my life studying moving averages because I'm a fool. I dug into article after article after article. There's different kinds of moving averages. They're used different ways. They're calculated in different ways. There's the slope of them and the combination of using more than one and how you can use more than one in different ways. There's a lot about moving averages. And that's just one indicator. MACD, I don't even know how many articles I've read on it, but I've spent months on the MACD, which ties into moving averages, by the way, because the MACD was built on moving averages and the spread of the two moving averages working together. So having a really thorough idea of what the indicator is that you choose, whichever one you happen to pick, and then because you've done that background in whatever indicator, you'll have a really good idea how to apply that in your work. So that if you bring up a chart, you'll have a really good idea what's your trade look like. Is it, a bottom fishing play, breakout to new highs, a range play for an iron condor, and then a checklist that you can go through. Where is its next earnings? Does it have a dividend? Who are its peers? What does the options look like? So that you have a more informed decision about the thing that you're going to trade. And then, of course, you got the community. So even after you do your research, if you want to validate that, put it in the chat and ask one of us. Oddly enough, nowadays you can take your chart and you can throw it at AI and ask the AI to do analysis on it. I don't tell you that so that you can try to get trade ideas from AI. I think that'd probably be a bad idea. But you can do research on something like UPS and make an informed decision. It's a buy, it's a sell, it's broken, it's good, it's bad. But after you're done with your analysis, give it to AI and see what it says. And do you two agree, disagree? How far away are you? If you think it's a long and it says it's a short or vice versa, it can at least offer a different opinion, different insight. For new traders, one thing that I've found is they don't yet understand that the market's not a black and white space to where it's obviously a buy, obviously a sell, or that it's a buy on all time frames or a sell on all time frames. So, I get to talking with a new trader and they'll say, "Oh, hey, by the way, I was looking at Caterpillar, blah, blah, blah. Where should I buy it? Or, where should I sell it?" And it's like, well, on what time frame? You're gonna buy it for the rest of the day? You're looking at holding it for the rest of the year? What makes you even think it's a long? Maybe it's a short. So your analysis has to fit the time frame that you're interested in. We are back to the 200 period daily moving average, by the way, and it's a flat 200 period moving average, which means we're getting a bit of a reciprocation. What we had on the top, we got on the bottom. Now we're back basically to the middle, although that's not exactly a good word to use, but yeah, we're back above the mean. We're not hitting the edge of the Bollinger Band on the weekly, and we are above the 400 period and the 200 period weekly. So if we're above the 10 week and holding strong and steady, this is still a long, and it will remain a long unless or until we begin to break over and fall back down. There was a physics analysis once done with stock and the relationship of price, and it said that the market will continue to do what it's doing until it hits equal or opposite reaction, right? So it's like the old physicist quote: "You'll get what you got until something else changes." That something else can be you hit the edge of a Bollinger Band, you had a bad earnings announcement, a headline, a drug trial that failed, something, right? So if we take Caterpillar for an example, unless or until we hit something, this is going to continue to go up unless we get news, right? Earnings is a ways off still. I think it's mid July. No, August 5. All right. So yeah, it's all the way to August. We got time. It's above all the major moving averages, still climbing. When you are doing your research, it does help to define, where am I wrong? I don't see this done enough, but I've never had a problem with getting in, right? It's always, where do I get out? Like, I don't need you to convince me to trade it. I want to trade it. Don't twist my arm, baby. The problem though is, at what point am I wrong and I shouldn't be in this anymore? If I make that decision after I'm in it, I always hate the outcome, because it seems like I'll decide to get out and the next day it'll do what I had wanted it to do all along. But if I don't get out and I stay in it, then it continues to just punish me brutally. So before I get in, I like to have the idea, where am I going to get out if I'm wrong? And do I like that answer? Because if I don't, I won't get in. So, for an example, where is wrong here? At the bare minimum, if we was to go long and we are wrong, we would go back to the mean at the bare minimum at the least. And that's 345. If we're at 365 and you're telling me that my long trade could fall to 345, I don't know if I like that answer. That's a 20-point drop. And even at that point, that would just tell us that we're back to the mean. We'd have to break the mean and go even lower before we'd say, yep, that long term long is broken. Do you like that? Because if you don't want to take a long in Caterpillar right now, because that's how far we could fall. And we wouldn't even be broken yet, right? Like that's a long ways. That's 20 points, and we wouldn't even be broken yet. So if you don't like that answer, you already know, yep, I can't take that long term long in Caterpillar. I could take a short term long and then, try to feed it into a longer term trade just by keeping it, rolling it, adjusting it, and that would bring us into a smaller time frame. But if I was looking at a January or a March of next year sort of trade, I would have to be comfortable with the idea that the stock could fall back to 340, maybe even 320, and that I still wouldn't know for sure if my long trade was broken or not. I would say that that gap right there at 325, if you close underneath that gap, your long is broken. That's a long ways off. Anything less than that would be a part of the gyrations for a daily, a weekly. Because look at what this thing does, big swings from 355 down to 340, and then back up, and then back down again. And then it finally broke out. So you got to be willing to hold through that sort of trash. And we would know that in advance if we looked at answering that question: how far could this thing go against me? That way we got a much better answer of, do I even want to trade this? Nah, I don't like that answer. Cool. Trade something else. Now you can always tighten everything up, right? So we could use a smaller time frame, we could use different gap levels, but take Caterpillar, this is kind of ugly, big gaps, missing data, a lot of sideways action the last few days. So getting into a smaller chart here didn't help, other than we've got a flat top rising wedge, higher lows with a flat top. So on a smaller time frame, we could define, a clear level of where should I get out if I go long and the long doesn't work. Very likely, it would be something like 356. Get this gap down here, so you could run, the open from 355 or the close from 353 and a half. That would break the 10-day, get you down to the 20. The problem is we could bounce on that 20 and still be good again. And that's unfortunate, but you have to make a sacrifice if you're going to get into the smaller term trade. So know your exit as a part of your analysis, that you have some tool or some rule that says if price reaches this level, I have to make a decision to reduce my position size or get out completely. And if you don't like that answer, then you already know you don't have a trade there. There is no um, new trader indicator set. That's usually a question I get. Like, oh, hey, I'm new. So what indicators should I use as a new trader? It doesn't work that way, unfortunately. If there was some perfect little checklist that we could say, okay, as a new trader, you should trade these stocks and use these indicators set to this time frame, then that's what everybody would do. And you wouldn't have to ask. You wouldn't even have to look around. It'd be on every website, in every video, and every article. Options will give you a chance to trade whatever you want. Sideways or um, not moving higher or not moving lower is actually a lot easier than trying to define where we are going to go. So, from a new trader perspective, if you try trading in that approach, I think you'll find it easier also. So, what I mean by that is if we look at something like the Qs and we say, hey, do you think we're going to make all time highs? And of course, since we're talking about options, do you think we're going to make all time highs by the first week of August? Can we get a close above 540 and 81 cents by August? August 1. How nice is that? It's the first day of the month on a Friday. And if your answer is no, you got to trade there. You could do a call credit spread, sell a 540, 545 call credit spread on the idea that we shouldn't close above that level on August 1st. It's as simple as that. And all you're trading here is the idea that you don't think we're going to stay bullish. You don't necessarily think we're bearish. You don't think we're going to go to 500. You just think we're not going to close above 540. See how easier that is. You could even shorten the time frame. You think we're going to close above 540 by next Friday? Now, you probably won't make much money in that trade, but it's still a trade. So here's the Qs. Here's next Friday's expiration. Let's put everything back on. And here's the 540. Told you probably wouldn't make much. That would make you $11 if you're right. After commissions, maybe make $7. But the point's still the same. And in this trade, we're not saying I think the Qs are going to go down because that's not really what we're saying. We're just saying I don't think we're going to close above 540. Now, since we changed the time frame, we can change the price. You think we're going to close above 535 by next Friday? Because if you don't, you can make $25 in that trade. And it's a lot easier to make that sort of an analysis than it is to say, I think we're going to go to 520. Well, now that is a directional bias. You think we're going down. So you'd focus on maybe buying a put at the 520. It's $357. If you're going to pony up that kind of money, probably going to need a reason to think you're right. Or you could just buy a debit spread, risk 40 to make 60 ish. So you don't necessarily need a directional bias. Anything that can give you edge that makes you think that top is going to hold and we won't close above it, or that gap is going to hold and we won't run down and close it. Anything like that that you can put a trade on because of. Unfortunately, how do you put that into a watch list, right? And sure, it's possible. There is software out there, but you're going to probably need to pay for it. Something that can give you a gap list or find particular patterns. Something I've been trying to use more lately, but I'm still not a big fan of it, is pattern software. Look at that $5 hold, man. It is still holding. So, TradingView has pattern software built into it. I was looking at the Nikkei last, so let's go to something that most of us would understand and be interested in trading. This is the SPX, and I've got multiple things on, so I'm going to turn some of that off. Let's go to a daily chart. turn the moving averages off because they're just noisy. And custom pattern detection. That's what I've got on right now. It's trying to run a little bit of a Elliott wave, kind of. It's trying to anticipate what the pattern is. Not a big fan of that. That one's more of an experiment than anything else. But we've got this one, and it's showing a double top, or AMD with this falling wedge and a head and shoulders down here, and also this big triangle up there. So it's pretty cool, all things considered. Um, like I said, I'm not really comfortable with this yet. I've been trying to use it a little bit more just to see the pattern, not to necessarily take a trade based on it. The pattern comes with a target because in technical analysis, that's how we're taught to do it, right? We're taught to measure out the pattern that you see and then apply the targets to it. When I see this, it doesn't tell me, oh, I should go long an apple and run it up to 170. But I see this and I see the both of these targets, the falling wedge and the head and shoulders, have a bullish bias. And if I put my moving averages back on, it's back above the 200 period, which also puts me in a bullish bias. It's this purple line right here. Unfortunately, it's a downward sloping 200 period daily moving average. And we talked about that, right? It's going to get above, but it's going to fail to keep it and it's going to fall back down again. So we know that, right? I don't have to chase this, but I can get a short term long, or I can get a short term short after it starts to fall back to the 200, and I can try again and get another long. No rush here at all. For a longer term trade, I could just sell like a 115, 100 put, something like that. Nice little put spread down there. And then when we do get a long, I can use that credit and buy a call, all things considered, right? Lots of ways to play it. So these patterns are really nice to add to your technical analysis. And if you don't know how to do them on your own, let the software do it, right? I mean, why not? It doesn't tell you to take the trade. It just helps you define, is this a bullish market or a bearish market on whatever time frame I happen to be on? Because this is daily. But if I went into a 15-minute, it may tell me that we're looking for a short on a 15-minute time frame, right? It's not, but it could have, or a 30-minute, right? Whatever. So it helps you define what time frame you're on. There's that falling wedge, by the way, on a weekly and on a daily. That's multiple time frame confluence. So let the software that exists help you better understand the market that you want to trade. If you're bullish and you bring up a chart and everything on that chart is bearish, at the bare minimum, it'll talk you out of your trade, even if it doesn't help you get into a new one. Just had to get a post out real quick. Done and done. So don't be afraid to use the software that's out there nowadays. This isn't necessarily going to educate you on technical analysis, but one, you can see a pattern through this software that maybe you didn't see on your own. So it can help that way. And then two, it can help you validate the analysis that you may have already done. So I think it can be helpful from a learning tool and from a validation tool to help validate whether or not you want to take a trade that you were thinking about taking. And as I said, I'm still trying to get comfortable with this, right? Um, I'm not sold. And speaking of these, I did mention Elliott Wave. They have that too. I never learned how to do Elliott Wave. I've always thought it was really cool, but it seemed very arbitrary to me. And so I struggled to convince myself it was worth the effort. I don't know any other way to say that. So that's the best I got. So I never learned how to do it. And I've talked to Elliott Wave professionals who have said that as an analysis tool for what we think is going to happen next, Elliott Wave is not very good. But from an analysis tool to describe what we already have been doing up to this point, that it is a really awesome tool. And I agree with that. I have heard Elliott Wave technicians describe how we got to our current location very well. Nice, articulate analysis. But when you ask those same technicians, okay, so what do you think it's going to do next? It completely unravels from there. They start to stutter and get all kinds of flustered, and they just don't have an Elliott Wave answer other than like this, right? It has this C target down here for an example. And they'll say, well, that's on the table. Because really, I got a bull pennant that says 52 and a half and 68 are on the table. So one of these ain't right. Still, it's another tool that you can turn on. And there's many more. I'm pointing out some of the, high flyers, but there are other ones. Here's another prediction analysis tool. And if you want to get into the individual candles, bearish engulfing, tweezer bottom, dojis, there's pattern candle patterns as well, candle recognition software. So give it a shot, right? Turn it on. And if you don't know why we should be interested on a bullish engulfing or a morning star or an evening star, whichever one, then you have something new to do. Go out and research some candle patterns. By all means, don't try to learn them all. One, that's just a lot. But two, we don't get all of them all the time, right? I can't remember what the candle was, but when I started studying candles, they said that there was a candle pattern that had some crazy success rate, right? Like a 90+% success rate. And I thought, that's fantastic. So I started digging into it. I was spending a lot of time on it until I got to the statistic that said it's damn near like winning the lottery. Your chances of actually finding that one candle pattern is like one in a million. I thought, well, who the hell cares if it has a really high success rate if I'm never going to find it, right? And so I quit studying it, which is why I don't remember the name of the darn thing. Kind of like the stochastics 20 cross. This is one that I learned really early in my trading, and it has a really high success rate to it. It's when the stochastics gets below the 20 period moving average, or the 20 period line in the sand down here, and then it climbs back up through it. It's a good time to put on a long trade. And you're supposed to do it on quality stocks that are already in an uptrend. You're basically just looking for a pullback in an uptrend. And so when I applied that to good names like Apple back in the day when I was learning this, we were in a bullish market back then. Apple hadn't hit that 20 line in like 2 years. And so I was like, well, what good is that going to do me? Looking for this really nice crossover to go long in something like Apple if Apple never goes down there to get it in the first place. And of course, if we're in a bear market, we don't care that it gets that cross up because, we're in a bear market. But It's a completely different discussion, anyway. So we can't use these as the end all of everything, whether it's a pattern, an indicator, it doesn't matter. We want to put the pieces together, put the moving averages together, the candle patterns, and then collectively we can say, well, what does it say? And run with our analysis on that. And make sure you're putting time on your analysis. I know that that might be confusing for newer traders, but if you analyze a chart on a daily, then you have a daily bias. You can say the daily moving averages are bullish, the daily stochastic is bullish. That doesn't mean on the 15-minute we should be bullish, right? Or even on the monthly that we should be bullish. So you can have a bullish weekly and a bearish daily or a bearish hourly. When you apply the words for the time frame into your analysis will begin to make more sense. So that you can say on the primary trend is bullish on the weekly, we're going sideways on the daily because the bullish is starting to top out. We're getting exhausted, and on the hourly, it's already started to fall. You see how it all starts to tie together when you put the words in with the time frame of the analysis, and then lay it out into a narrative. So hopefully this afternoon we covered those two topics: how to conduct effective research. Now, I didn't get into the research part. I just got into the analysis part. You wouldn't use fundamentals for an options trade unless it's an options trade that is enhancing a stock position, right? We trade stock on fundamentals. Well, fundamentals are used to better understand a stock position. Let's say it that way. And research, that's actually a part of the article that I'm writing for the new traders. Not even an article, like a whole series. New traders have to learn how to do math, have to learn how to do analysis, have to learn how to use software, like just basic things like how to use Google, how to use YouTube. It sounds silly until you're the new trader who hasn't done any of it before. Everybody thinks learning to trade means learning about price action and candle patterns, but learning how to trade means learning how to perform research, get answers to questions, even knowing what questions to ask. Well, yeah, that was loud in the ears. So that's a work in progress. Not there yet. But if you think about it, new traders, they got to learn all sorts of stuff: apps, brokers, browsers, software, how to use a computer. The Getting into how to do research is going to go directly into the heart of that. What's good info? What's bad? How to tell the difference? How to avoid clickbait? And there is a ton of free info out there that is really good. The fact that it's free doesn't have anything to do with the quality of the material. And I've had people say, well, it's free. It's obviously no good. Or that everything out there is just clickbait trash. And that's absolutely not true. But being able to tell the difference is a big deal. As always, if you guys have topics that you want to cover, hit me up in the chat. The more specific you are, the more specific I can be in how we frame out what we want to discuss. And we can dig into anything. We did get a request for macro concepts. I'm willing to kind of kick the door open a little bit, but you know, we can't go through an economics course in here. It's just outside the scope of what we want to focus on. But if y'all don't have any questions, I'd say let's get this weekend started. All right. Everybody, have a good weekend. I'll see you all on Monday. And